Question 1. Which of the following is a characteristic feature of non-proportional reinsurance? A. Reinsurer assumes a fixed percentage of premiums in proportion to the ceding company's premiums. B. The reinsurer's liability is triggered only after the ceding company's losses exceed certain threshold. C. The reinsurance arrangement covers all types of risks, regardless of the nature of the loss. D. The reinsurer directly shares in the profits and losses of the ceding company based on predetermined percentage. Answer. B. The reinsurer's liability is triggered only after the ceding company's losses exceed certain threshold. Explanation. Non-proportional reinsurance, such as excessive loss or stop loss, involves reinsurer's liability being triggered only when the ceding company's losses surpass defined retention limit threshold. Unlike proportional reinsurance, where the reinsurer assumes fixed share of both premiums and losses, non-proportional reinsurance focuses on covering large, unexpected losses that exceed pre-agreed retention level. The ceding company is responsible for losses up to this threshold, and only above that does the reinsurer take on responsibility. Question 2. Scenario-based. Mr. Smith, the chief risk officer of a major insurance company in Alabama, is considering renewing the company's catastrophe reinsurance treaty. The treaty includes both an excessive loss reinsurance structure and a quota share reinsurance arrangement. The company is expecting several large risks in the coming year. Mr. Smith is reviewing the potential impact on the company's capital and loss reserves. Which of the following Mr. Smith consider the most important when deciding to renew the treaty? A. The overall solvency ratio and impact on the company's ability to cover losses within the retention limits. B. The ability of the reinsurer to pay claims in timely manner, considering their financial strength and rating. C. The duration of the treaty renewal clause and its potential impact on future treaty negotiations. D. The potential changes in the tax treatment of reinsurance premiums paid to international reinsurers. Answer. A. The overall solvency ratio and impact on the company's ability to cover losses within the retention limits. Explanation. Mr. Smith should primarily focus on the solvency ratio and the impact of the reinsurance treaty on the company's ability to manage losses within its retention limits. Solvency is a key factor ensuring that the insurance company can absorb losses without jeopardizing its financial stability. The quota share reinsurance arrangement will impact the company's ability to spread risk, while excessive loss reinsurance will help cover catastrophic losses beyond the retention limit. Both structures are designed to maintain solvency and capital adequacy. Reinsurers' financial stability, B, and tax considerations, D, are also important but secondary to the company's ability to absorb risk and maintain solvency. The duration of the renewal clause, C, is relevant for future negotiations but doesn't directly address the immediate financial health of the company. Question 3. What is the primary difference between quota share reinsurance and surplus share reinsurance? A. Quota share reinsurance involves the reinsurer assuming a fixed percentage of losses, while surplus share reinsurance only applies to risks above a certain threshold. B. Quota share reinsurance shares premiums and losses based on a fixed percentage, while surplus share reinsurance allows the reinsurer to assume part of the risk based on the insurer's capacity to retain business. C. Quota share reinsurance is used for small risks. Surplus share reinsurance is used only for large-scale catastrophic risks. D. Quota share reinsurance involves a fixed premium sharing model, while surplus share reinsurance involves premiums being shared based on claims frequency. Answer. B. Quota share reinsurance shares premiums and losses based on a fixed percentage, while surplus share reinsurance allows the reinsurer to assume part of the risk based on the insurer's capacity to retain business. Explanation. In quota share reinsurance, the reinsurer and the ceding company share premiums and losses on a fixed percentage basis, regardless of the size or type of the risk. Its structure is proportional. In contrast, surplus reinsurance allows the reinsurer to assume part of the risk above a certain retention limit based on the insurer's capacity to retain business. The surplus share reinsurance arrangement is often used for larger risks where the ceding company is willing to retain part of the risk but cedes the excess portion to the reinsurer. Question 4. Which of the following best describes the key difference between facultative reinsurance and treaty reinsurance? A. Facultative reinsurance is automatically applied to all policies, whereas treaty reinsurance requires individual approval. B. Facultative reinsurance applies to specific risks that are negotiated individually, while treaty reinsurance covers a block of business under a pre-agreed contract. C. Facultative reinsurance only applies to large commercial risks, while treaty reinsurance applies to individual household policies. Facultative reinsurance is based on fixed premiums, while treaty reinsurance is based on a variable percentage of premiums. Answer B. Facultative reinsurance applies to specific risks that are negotiated individually, while treaty reinsurance covers a block of business under a pre-agreed contract. Explanation: facultative reinsurance is a form of reinsurance that is negotiated on a case-by-case basis for individual risks. The reinsurer decides whether to accept or decline each specific risk presented by the ceding company. In contrast, reinsurance is a more general arrangement in which the reinsurer agrees to accept a specified type of business from the ceding company, covering a block of policies without the need for individual negotiation. Facultative reinsurance allows for more flexibility and negotiation, while treaty reinsurance provides broader coverage with predefined terms. Question 5. Scenario-based. Mrs. Taylor, the chief underwriting officer of an insurance company, is reviewing the company's reinsurance arrangements for the upcoming year. The company is considering proportional reinsurance treaty, specifically quota share reinsurance. The company has experienced significant increase in premium volume this year, and the risk exposures are becoming more diversified. What should Mrs. Taylor focus on to ensure reinsurance treaty is structured effectively? A. The ceding company's retention limit, ensuring it is adequate to cover the increased premium volume without additional risk exposure. B. The reinsurer's pricing methodology, ensuring that it aligns with the company's claims history and premium trends. C. The proportion of business ceded to the reinsurer, ensuring it corresponds with the company's capacity to retain risk while achieving adequate risk transfer. D. The duration and renewal clauses treaty, ensuring the company can renew the agreement without significant renegotiation. Answer: C. The proportion of business ceded to the reinsurer, ensuring it corresponds with the company's capacity to retain risk while achieving adequate risk transfer. Explanation: in proportional quota share reinsurance arrangement, the ceding company shares fixed percentage of both premiums and losses with the reinsurer. Mrs. Taylor should focus on ensuring that the proportion of business ceded to the reinsurer is well aligned with the company's capacity to retain risk while achieving effective risk transfer. The goal is to balance the risk retention with the need for external support to manage large losses. While retention limits A and pricing methodologies B are important considerations, ensuring the correct proportion of ceded business directly impacts the risk-sharing arrangement. The duration of the treaty D is more relevant to long-term strategy but does not directly affect the immediate structuring of the treaty. Question 6. Which of the following is a key factor that influences reinsurance pricing models? A. The type of insurance policies issued by the ceding company. B. The reinsurer's financial stability and credit rating. C. The retention limits set by the ceding company. D. The regulatory framework governing the ceding company's domicile. Answer: B. The reinsurer's financial stability and credit rating. Explanation: reinsurance pricing is heavily influenced by the reinsurer's financial stability and credit rating because these factors determine the likelihood that the reinsurer will be able to meet its financial obligations in the event of large claims. A financially stable reinsurer is seen as less risky and therefore may offer more competitive pricing. The type of policies issued. Ceding company A, retention limits C, and the regulatory framework D all play roles in shaping the reinsurance arrangement but are secondary factors compared to the reinsurer's financial strength in pricing models. Question 7. What is the primary purpose of stop-loss reinsurance? A. To cover the losses of an insurer that exceed a specified dollar amount in a single risk. B. To protect the insurer from aggregate losses that exceed a certain amount over a specified period. C. To reinsure individual high-value policies that are outside the insurer's normal underwriting guidelines. D. To provide reinsurance coverage for losses that occur after the retention limit has been exhausted, regardless of the amount. Answer: B. To protect the insurer from aggregate losses that exceed a certain amount over a specified period. Explanation: stop-loss reinsurance is a form of non-proportional reinsurance that protects the ceding company from aggregate losses that exceed a specified amount over a given period. This form of reinsurance is designed to limit the ceding company's total exposure to loss within defined timeframe, e.g. year. It is different from a loss reinsurance, which focuses on individual large losses. Stop loss is particularly useful for insurers facing risk of multiple smaller losses accumulating to an unexpectedly high total. Question 8. In reinsurance, what is the primary function of the excessive loss treaty structure? A. To limit the reinsurer's liability to a fixed percentage of the ceding company's losses. B. To cover losses that exceed the ceding company's retention limit up to specified amount. C. To share losses between the reinsurer and the ceding company on 50-50 basis for all claims. D. To provide coverage for the ceding company's premiums in excess of the market rate. Correct answer. B. To cover losses that exceed the ceding company's retention limit up to specified amount. Explanation. The excessive loss treaty structure is a form of non-proportional reinsurance designed to cover large unexpected losses that exceed certain retention limit. This type of reinsurance only applies once the ceding company's losses surpass pre-established threshold, protecting the insurer from large claims that could otherwise impair its financeability. Unlike proportional reinsurance, the reinsurer's liability is not based on percentage of premiums, but on the amount of loss exceeding the retention limit. Question 9. Which of the following is most likely to trigger a reinsurance claim under an excessive loss reinsurance treaty? A. A single large loss that exceeds the retention limit defined in the reinsurance agreement. B. A cumulative loss from multiple small claims that exceed the retention limit over a specified period. C. A claim resulting from an event that is not covered by the primary insurance policy. D. A loss that is within the retention limit but exceeds the insurer's underwriting guidelines. Answer A. A single large loss that exceeds the retention limit defined in the reinsurance agreement. Explanation. Under an excessive loss reinsurance treaty, the reinsurer is only liable when the ceding company's losses exceed a defined retention limit. This type of reinsurance is specifically designed to address large unexpected losses, e.g., a single catastrophic event that go beyond the company's ability to absorb them, while cumulative losses, B, and losses outside of the coverage scope, C, may be relevant to other forms of reinsurance. They are not the primary trigger for excessive loss reinsurance claims. Losses within retention limits, D, would not activate the excessive loss coverage. Question 10. What is a key characteristic of reinsurance pools? A. They allow multiple insurers to share in the risks associated with a single insurance policy. B. They are designed to manage systemic risk by allowing multiple insurers to pool their capital and cover larger losses. C. They primarily involve a fixed amount of premium payment shared equally among the members. D. They only provide coverage for specific types of insurance, such as health or auto insurance. Answer. B. They are designed to manage systemic risk by allowing multiple insurers to pool their capital and cover larger losses. Explanation. Reinsurance pools are formed by multiple insurers to collectively share the burden of large, catastrophic losses. By pooling their resources, insurers can manage systemic risks more effectively, ensuring they have enough capital to cover substantial losses that would otherwise exceed the capacity of any individual insurer. Arrangement is particularly beneficial for covering large-scale events, such as natural disasters, that could impact multiple insurers simultaneously. Pools do not necessarily involve equal premium sharing, C, and are not limited to specific insurance types, D. Question 11. What does the term retrocession in reinsurance refer to? A. A type of reinsurance that covers the cedant's excess losses. B. The transfer of reinsurance risk from one reinsurer to another. C. The process by which an insurer seeks coverage from the primary market. D. A reinsurance treaty that covers a specific type of risk, such as earthquake or flood. Answer. B. The transfer of reinsurance risk from one reinsurer to another. Explanation. Retrocession is the practice where a reinsurer transfers part of its risk to another reinsurer, known as the retrocessionaire. This is common in the reinsurance market as reinsurers look to spread their risk further. Question 12. What type of risk is typically covered by catastrophe reinsurance? A. Small, frequent losses that do not significantly affect the insurer's solvency. B. Large, infrequent losses resulting from natural or man-made disasters. C. Operational risks associated with insurance company management. D. Claims arising from regulatory changes or lawsuits. Answer. B. Large infrequent losses resulting from natural or man-made disasters. Explanation: catastrophe reinsurance is designed to protect insurers from large, unexpected losses resulting from events such as earthquakes, hurricanes, or other large-scale disasters. These types of losses occur infrequently but can have a significant financial impact. Question 13. Scenario-based. The Zeiss Insurance Company has been struggling with high claims in its property insurance segment, especially due to an increase in weather-related damage. They decide to enter into an excessive loss reinsurance agreement. The treaty will cover losses exceeding $5 million for a single event. If a major hurricane causes $8 million in damage, how much of the claim will the reinsurer cover? A. $3 million. B. $5 million. C. $8 million. D. $0. Answer A. $3 million. Explanation: the reinsurance treaty covers losses above the $5 million retention limit. Since the total damage is $8 million, the reinsurer will cover the difference, which is $3 million. The ceding company retains the first $5 million. Question 14. Which of the following is not typically a feature of facultative reinsurance? A. It applies to individual risks on a case-by-case basis. B. The ceding company must offer the risk to the reinsurer. C. It automatically covers a block of business under a preset agreement. D. The reinsurer has the right to accept or decline each risk presented. Answer: C. It automatically covers a block of business under a preset agreement. Explanation: facultative reinsurance is specific to individual risks and requires negotiation and acceptance by the reinsurer on a case-by-case basis. Unlike treaty reinsurance, it does not automatically cover a block of business. Question 15. In reinsurance, what is the primary purpose of claims-made coverage? A. To cover losses incurred during the term of the policy regardless of when the claim is reported. B. To cover losses that occur and are reported within a specified time frame after the policy expires. C. To provide coverage for losses that are discovered during the policy period even if the event occurred earlier. D. To cover only the claims that arise from claims made during the policy period. Answer: D. To cover only the claims that arise from claims made during the policy period. Explanation: claims-made coverage is a type of insurance policy where coverage is provided for claims made during the policy period, regardless of when the actual incident occurred, as long as the claim is reported within the policy period. Question 16. In a reinsurance treaty, what is the ceding commission? A. The commission paid to the ceding company for underwriting the business. B. A percentage of the premiums paid to the reinsurer. C. The portion of the premiums that the reinsurer pays to the ceding company to cover acquisition and administrative costs. D. A fee charged by the ceding company for providing underwriting services. Answer: C. The portion of the premiums that the reinsurer pays to the ceding company to cover acquisition and administrative costs. Explanation: the ceding commission is the percentage of the premium that the reinsurer pays to the ceding company to help cover the costs of underwriting, acquiring, and administering the policies that are ceded to the reinsurer. Question 17. Which of the following types of reinsurance agreements would most likely involve the reinsurer assuming a fixed percentage of all premiums and losses? A. Excessive loss reinsurance. B. Facultative reinsurance. C. Quota share reinsurance. D. Stop loss reinsurance. Answer: C. Quota share reinsurance. Explanation: quota share reinsurance is a type of proportional reinsurance where the reinsurer assumes a fixed percentage of both the premiums and losses. The ceding company retains the remaining percentage. Question 18. In reinsurance, what is meant by the term cedent? A. The reinsurer that accepts the risk. B. The policyholder who purchases the insurance. C. The insurance company that transfers the risk to the reinsurer. D. The entity that evaluates the risk for the reinsurer. Answer: C. The insurance company that transfers the risk to the reinsurer. Explanation: the cedent is the insurance company that cedes or transfers a portion of its risk to a reinsurer. This helps the cedent manage its exposure to large losses. Question 19. What is the key advantage of treaty reinsurance for a ceding company? A. It allows the ceding company to transfer all underwriting responsibilities to the reinsurer. B. It provides an automatic and continuous agreement for a specified block of business. C. It guarantees a higher percentage of premiums returned to the ceding company. D. It limits the ceding company's responsibility for risk to only the largest losses. Answer: B. It provides an automatic and continuous agreement for a specified block of business. Explanation: treaty reinsurance provides the ceding company with continuous coverage for a specified block of business under an automatic agreement. This helps streamline the reinsurance process and ensures that the ceding company is consistently protected. Question 20. Scenario-based. ABC insurance company has entered into a treaty reinsurance agreement with a retention limit of $10 million. A single loss event results in $15 million in claims. How much will the ceding company retain under this reinsurance treaty? A. $5 million. B. $10 million. C. $15 million. D. $25 million. Answer: B. $10 million. Explanation: in this case, the ceding company will retain the first $10 million of the loss, as per the retention limit of the treaty. The remaining $5 million will likely be covered by the reinsurer, depending on the specific terms of the reinsurance treaty. Question 21. What does adverse selection refer to in the context of reinsurance? A. When the reinsurer selects only profitable risks to accept. B. When the insurer offers excessive coverage at very low premiums. C. When the ceding company experiences higher than expected losses because high-risk individuals or entities are more likely to buy insurance. D. When the insurer rejects all high-risk policies and only accepts low-risk ones. Answer: C. When the ceding company experiences higher than expected losses because high-risk individuals or entities are more likely to buy insurance. Explanation: adverse selection occurs when high-risk policyholders are more likely to purchase insurance, leading to higher than expected claims for the insurer or ceding company. This is a common concern in both primary insurance and reinsurance markets. Question 22. Which of the following is an example of a non-proportional reinsurance arrangement? A. Quota share reinsurance. B. Facultative reinsurance. C. Excessive loss reinsurance. D. Stop loss reinsurance. Answer: C. Excessive loss reinsurance. Explanation: excessive loss reinsurance is a form of non-proportional reinsurance where the reinsurer only covers losses that exceed a certain threshold without sharing a proportional percentage of premiums or losses. Question 23. What is the primary risk management benefit of reinsurance for an insurer? A. It allows the insurer to reduce the premium rates for customers. B. It ensures that the insurer never has to pay out any claims. C. It helps the insurer spread risk and stabilize its financial position. D. It enables the insurer to acquire more customers by offering broader coverage. Answer: C. It helps the insurer spread risk and stabilize its financial position. Explanation: reinsurance allows insurers to manage their risk exposure by transferring some of the risk to other companies. This helps to stabilize the insurer's financial position, particularly in the event of large or catastrophic losses. Question 24. Which of the following best describes a burning cost in reinsurance? A. The total amount of premiums the ceding company has paid to the reinsurer. B. The amount of losses the ceding company expects to experience based on historical data. C. The percentage of premiums that the reinsurer keeps for its operational costs. D. The reinsurance premiums paid for catastrophic events in a given year. Answer: B. The amount of losses the ceding company expects to experience based on historical data. Explanation: the burning cost refers to the expected loss experience of an insurer, which is typically based on historical claims data. It is used in calculating reinsurance premiums to ensure that the insurer adequately covers potential future losses. Question 25. What type of reinsurance involves the reinsurer agreeing to cover all losses for a specified category of risks within a predetermined retention limit? A. Facultative reinsurance. B. Quota share reinsurance. C. Excessive loss reinsurance. D. Treaty reinsurance. Answer: D. Treaty reinsurance. Explanation: treaty reinsurance involves a pre-agreed arrangement where a reinsurer agrees to cover losses within specific categories of risks that fall within the scope of the treaty. This type of reinsurance is automatic and continuous. Question 26. What does the term surplus share reinsurance refer to? A. A type of reinsurance where the reinsurer takes a fixed percentage of both premiums and losses. B. A reinsurance agreement where the reinsurer shares a portion of the surplus capital of the ceding company. C. A reinsurance arrangement where the reinsurer covers losses exceeding the ceding company's retention limit based on the size of the policy. D. A reinsurance agreement where the ceding company transfers all of its liabilities to the reinsurer. Answer C. A reinsurance arrangement where the reinsurer covers losses exceeding the ceding company's retention limit based on the size of the policy. Explanation. Surplus share reinsurance involves the reinsurer covering a portion of the losses. Once they exceed the ceding company's retention limit, the reinsurer's share is based on the size of the policy, allowing them to assume portion of the risk that exceeds the retention. Question 27. Scenario-based. Zai's insurance company has a quota share reinsurance agreement in place where it cedes 60% of its premiums and losses to a reinsurer. If Zai's issues a policy with a premium of $1,000 and the claims for that policy amount to $500, how much of the premium and claim will Zai's retain? A. Zai's retains $400 of the premium and $200 of the claim. B. Zai's retains $600 of the premium and $300 of the claim. C. Zai's retains $400 of the premium and $300 of the claim. D. Zai's retains $600 of the premium and $200 of the claim. Answer A. Zai's retains $400 of the premium and $200 of the claim. Explanation. In a quota share agreement, Zai's retains a portion of the premium and claims. Since Zai's retains 40%, 100%, 60% of the premium, it keeps 40% of both the premium and the claim. 40% of $1,000 is $400 and 40% of $500 is $2. Question 20. Which of the following is a key disadvantage of facultative reinsurance compared to treaty reinsurance? A. It requires a case-by-case analysis for each risk, leading to higher transaction costs. B. It automatically covers a broad block of business. C. It covers only catastrophic events, not individual risks. D. It is less flexible than treaty reinsurance in terms of risk management. Answer A. It requires a case-by-case analysis for each risk, leading to higher transaction costs. Explanation. Facultative reinsurance requires the reinsurer to assess each risk individually, which can lead to higher transaction costs and administrative burden. In contrast, treaty reinsurance provides automatic coverage for a block of business. Question 29. In the context of reinsurance, what does the net retention of an insurer refer to? A. The total amount of risk the insurer retains after ceding part to a reinsurer. B. The portion of claims paid by the reinsurer. C. The amount of premium income that the insurer receives after paying the reinsurer. D. The capital that the insurer reserves for future claims. Answer A. The total amount of risk the insurer retains after ceding part to a reinsurer. Explanation. Net retention is the amount of risk that the insurer retains for its own account after purchasing reinsurance. It represents the insurer's exposure to risk that is not transferred to the reinsurer. Question 30. Which of the following is not typically a factor considered when determining the terms of reinsurance? A. The ceding company's financial strength. B. The claims history of the ceding company. C. The location of the ceding company's offices. D. The types of risks being underwritten. Answer C. The location of the ceding company's offices. Explanation. When determining the terms of reinsurance, factors such as financial strength, claims history, and the types of risks underwritten are important. The location of the ceding company's offices is generally not significant consideration in setting reinsurance terms.